You can be in a lower tax rate later in life, and a Roth conversion can still make sense. Most people and even some professionals overlook this. Today, we're going to talk about BETR, or break even tax rate. BETR is the future tax rate where converting and not converting end up in the exact same place in terms of after tax wealth. Now, one of the biggest mistakes I see in Roth conversion planning is people treating all conversions like they're the same, but they're not. A conversion where taxes are withheld from the IRA is not the same as a conversion where taxes are paid from a taxable brokerage account. Why? Because if you pay the tax from the IRA, you are shrinking the amount that makes it into the tax-free Roth IRA, where if qualified distribution rules are met, this keeps the IRS from taking a share of the growth and withdrawals from the account going forward. And that's a big part of what we focus on at JRS, helping you keep more of what you've earned through thoughtful planning. If you pay the tax from non-IRA assets, you're effectively converting more dollars even though the total conversion amount didn't change. Now, this isn't to say that if you don't have taxable brokerage that it's never makes sense to do a conversion and pay taxes from your IRA, but the math changes and it becomes more advantageous if you are able to pay from a taxable brokerage account. Paying from the taxable brokerage account can push the BETR below your current marginal rate, especially when the taxable account is tax inefficient or the holding period is expected to be long. One important caveat here, this assumes you use those taxable dollars without triggering significant capital gains taxes from selling investments. If paying the conversion tax requires realizing gains, that can reduce some of the benefit. So let's walk through a simplified example. Let's assume someone is considering a $100,000 Roth conversion. The $100,000 would be in the 24% marginal tax rate if converted today. They project that $100,000 will be withdrawn later in the 22% marginal tax rate. And let's assume the money stays invested for 20 years. For the IRA or Roth, we'll use a 6% annual growth assumption. And for the taxable brokerage account, we'll use a 4.5% after-tax growth assumption. This assumes ongoing tax drag from dividends, interest, and realized gains. Now, these numbers are just for illustrative purposes, but they're reasonable for teaching the BETR concept. Now, let's compare two different ways of doing the exact same $100,000 conversion. Now, before I begin, for simplicity purposes, I am going to assume the full $100,000 conversion is entirely in the 22 or 24% bracket. In reality, tax brackets are progressive, so conversions might span multiple marginal tax brackets. First scenario, taxes withheld from the IRA. A $100,000 conversion at the 24% marginal tax rate creates a $24,000 tax bill. If that tax is withheld from the IRA, only $76,000 actually lands in the Roth. Now let that $76,000 grow at 6% for 20 years. That becomes about $243,000 in the Roth, tax-free on the back end, assuming qualified distribution rules are met. Now compare that to not converting. If the $100,000 stays in the traditional IRA and grows at 6% for 20 years, it becomes about $320,000. If the future marginal tax rate on those withdrawals is 22%, the after-tax value is about $250,000. In this simplified example, the BETR is roughly equal to your current marginal rate. So in this version, the traditional thinking holds up. Convert only when at a lower projected marginal rate than you will be in the future. Now let's change just one variable and watch what happens. Same $100,000 IRA, same 24% tax rate, same 20-year time horizon. But this time, instead of withholding taxes from the IRA, we pay the $24,000 tax bill from a taxable brokerage account. That means the full $100,000 goes into the Roth. Let that grow at 6% for 20 years, and now the Roth is worth about $320,000, again tax-free on the back end if qualified distribution rules are met. So what are we comparing it against? If you do not convert, the traditional IRA still grows to about $320,000, and after a 22% future tax, that leaves about $250,000. In the no conversion scenario, you also still have about $24,000 sitting in the taxable brokerage account. If that grows at a rate of 4.5% after tax for 20 years, it becomes about $58,000. So the no conversion total is about $308,000. The conversion total is about $320,000. Now, in this example, the conversion results in higher after tax wealth, even though nothing changed except where the tax was paid from. When taxes are paid from the IRA, the break even future tax rate is basically your current tax rate in this simplified setup. When taxes are paid from the taxable assets, the break even future tax rate drops. That's what BETR is capturing. In this example, the implied BETR is around 18%. That means that any conversion above 18% is projected to be beneficial for you. Now, I don't want to bore you with the math if that isn't interesting, but if it is, pause the video here. So even though the future tax rate is lower than today's 24%, a Roth conversion may still be worth considering because 22% is still above that break-even rate. Now, it's important to note that BETR is not fixed. It changes based on time horizon, return assumptions, and how the taxes are paid. That's why two people in the exact same tax bracket can make completely different and still reasonable decisions. There are a few more layers that matter. First, time horizon. The longer the money stays invested, the more attractive it can be to pay conversion taxes from outside assets because you're giving the larger Roth balance more years to compound tax-free. Second, traditional IRA basis. If part of the traditional IRA is after-tax money, that lowers the tax cost of conversion and can lower BETR too. So somebody with non-deductible basis may have a stronger case for converting than a quick bracket comparison would suggest. Another situation where this comes into play is backdoor Roth contributions. An example would be someone who earns too much to contribute directly to a Roth IRA, but has a relatively small pre-tax or traditional IRA balance. By clearing out or converting that pre-tax IRA, even at a higher marginal tax rate, you can open the door for clean backdoor Roth contributions for years to come. And an even better option, if available, is often rolling those pre-tax IRA funds into an employer 401k, which eliminates the pro rata issue altogether. And then there are real-world planning issues that don't always show up neatly in a calculator. Roth IRAs do not have lifetime RMDs for the original owner. Qualified Roth withdrawals generally do not increase taxable income the way traditional IRA withdrawals or conversions do. That can matter for Medicare IRMA, ACA premium subsidies, taxation of Social Security benefits, the widow trap, or the shrunken tax brackets widows have to deal with, eligibility for certain credits or subsidies, and also just the overall tax flexibility that comes from having pre-tax and post-tax funds. An additional point, if someone is under the age of 59 and a half, the conversion itself is generally not subject to the 10% penalty, but any amount withheld for taxes and not actually converted may be treated as an early distribution and could trigger that additional tax unless an exception applies. This video is for educational purposes only, and it's not personalized tax or investment advice. If you're thinking about doing a Roth conversion and you want help applying this to your situation, JRS offers a free retirement clarity video review. Just fill out the intake form in the description and we'll be in touch. And as always, money is a tool, knowledge is freedom, and planning is power. I hope you have a great rest of your day.